Welcome to the deep dive. Did you know that the money you rely on from Social Security or railroad retirement benefits, the payments you've earned, might actually be taxable?
It's true.
For many people, that comes as a genuine surprise when tax season rolls around.
Oh, definitely. A big surprise for some.
Today, we're cutting through the noise to give you a shortcut to being well-informed on a topic that touches millions, specifically how the IRS looks at your Social Security and railroad retirement benefits when it's time to file taxes. We're going to sort of demystify the official guidance, unpack the numbers, and uncover some truly surprising facts and powerful insights, especially when it comes to understanding your tax forms and, maybe more importantly, finding smart ways to optimize your tax position.
That's right. Our focus today is really on IRS publication 915 for 2024 returns, which is, well, basically the definitive guide on the subject straight from the source. Our goal is to walk you through how to understand your benefit statements, how to figure out if, and crucially, how much of your benefits are taxable. And like you said, most importantly, highlighting specific strategies that could potentially reduce your tax liability. It's all about empowering you with practical, actionable knowledge you can actually use.
Exactly. Our mission is to equip you with the knowledge to navigate this part of your tax return with confidence. We want to help you spot those aha moments, the ones that can make a real difference in your financial picture, transforming what might seem like a complex, overwhelming calculation into a clear, understandable process.
Okay, let's unpack this then. Before we even dive into the nitty-gritty of calculations, how do you know if you're even dealing with these specific benefits for tax purposes? I mean, you get mail from various agencies throughout the year. What are the core documents you should be looking for to kick off your tax preparation? That's a perfect starting point because identifying the right forms is, well, it's the absolute first step in understanding your tax situation regarding these benefits. You'll be looking for two primary documents. Form SSA Day 099. That's your Social Security benefit statement.
Okay, SSA 1099.
And Form RRB 1099, which is issued by the Railroad Retirement Board. Now, the RRB Day 999 specifically deals with the Social Security Equivalent Benefit, or SSA, portion of Tier 1 benefits, so a bit more specific there.
Right.
These forms are crucial because they summarize all the necessary information for your tax return in a standardized way. Makes it much easier to plug into your tax software or, give to your preparer.
And for our listeners who might not be U.S. residents, are there equivalent forms they should be aware of? Are there any specific nuances for them?
Absolutely. Yeah, good question. For non-resident aliens, there are corresponding forms. SSA 1042S and RB 1042S. These forms contain the same core benefit information, but also include additional details relevant to non-resident status, like the tax rate at which tax was withheld and any amounts of tax refunded. And what's particularly, fascinating for non-residents is that benefits for residents of certain treaty countries, think Canada, Germany, Ireland, Japan, the UK, might actually be exempt from U.S. tax entirely.
Wow, entirely.
Yeah, this is a significant exclusion to be aware of if it applies to you. It could mean your U.S. Social Security or railroad retirement benefits aren't subject to U.S. taxation at all. Big deal if you qualify.
Okay, so once you have these forms in hand, the 1099 or the 1042S, what's the single most critical piece of information on them? Is there one specific box or number that truly acts as the foundation for all your tax calculations for these benefits?
Yes, there absolutely is. While the entire form is important for your records, the critical amount you'll use for tax purposes is the net benefits.
Huh.
That's shown in Box 5 on either Form SSA 199 or RRB 109.
Box 5. Got it.
And this Box 5 amount isn't just a random figure. It represents the total benefits you were paid during the year. That's usually in Box 3 minus any benefits you repaid during the year, which are detailed in Box 4.
Okay, so paid minus repaid equals net benefits in Box 5.
Exactly. It's the bottom line for your received benefits for the year. Now, here's a crucial detail and a fantastic initial aha moment for many listeners, a true tax-saving insight right off the bat.
Ooh, okay.
If the figure in Box 5 is 0, or, even better, a negative figure.
Negative? How can it be negative?
It means you repaid more benefits than you actually received in 2024. Maybe you got an overpayment notice and paid back more than that year's benefits.
Oh.
In such a scenario, none of your Social Security or railroad retirement benefits are taxable for the year, period.
Wow.
This is your first immediate win understanding when you're completely in the clear and don't need to proceed with any further complex calculations for these benefits. It's a quick check that can save you significant time and, frankly, provide immense peace of mind.
So if you rip open your annual statement, you look at Box 5 and see a big 0 or a negative number, you've already had a game-changing realization. No taxable benefits from this source for you.
That's it. A huge relief for many.
What about the other boxes? Like, I know people often wonder about Medicare premiums or how much tax was already withheld. Do those play a direct role in the taxability calculation itself?
That's another common point of confusion, and it's really important to clarify this. While other boxes on these forms are indeed important, they don't directly factor into the calculation of your taxable benefits.
Okay.
For instance, Box 6 on SSA 1999 or Box 10 on RRB Quota 99 shows voluntary federal income tax withheld. This is tax you've already paid, right? You'll include this amount on your tax return as a payment or credit against your overall tax liability, but it doesn't change how much of your benefit is considered taxable income.
So it reduces your final tax bill, but not the taxable amount of the benefit itself.
Precisely. It's simply money the IRS already has from you for the year. Similarly, on Form RRB 1099, Box 11 shows Medicare premium total. This amount represents Medicare Part B, C, or D premiums deducted from your railroad retirement annuity payments. It's provided for informational purposes only. The RRB doesn't even report this amount to the IRS. And crucially, this is a key point. You should not reduce the amount of net benefits in Box 5 by any Medicare premiums for the purpose of figuring your taxable Social Security or railroad retirement benefit.
Oh, okay. That seems like a common mistake people might make.
It really is. They see the deduction and think they can subtract it, but for this calculation, you can't. They are not deductible from Box 5. Understanding what to exclude from your Box 5 calculation for this specific purpose is just as important as knowing what to include. It's a key part of avoiding errors and potentially overpaying.
That makes a lot of sense. So the core is truly Box 5 for determining taxability, and then everything else is either tax already paid or simply for your information, not directly affecting the taxable portion of the benefits themselves. That's a clear roadmap for starting out, helping our listener navigate this item by item.
Exactly. Start with Box 5.
Okay, here's where it gets really interesting, I think. Once you have that critical Box 5 number, the IRS provides a kind of quick check to see if you even need to bother with the more complex calculations for your Social Security or railroad retirement benefits. It's called Worksheet A, right? And it can be a true tax-saving shortcut because it quickly tells you if your benefits will escape taxation altogether.
Exactly. Think of Worksheet A as your first filter. It helps you determine your provisional income, which is a key figure the IRS uses to compare against certain base amounts. This base amount is a critical threshold that varies depending on your tax filing status. This is super important.
Okay, what are the amounts?
Right. If you're filing as single, head of household, or a qualifying surviving spouse, your base amount is $25,000.
$25,000.
For those married filing jointly, it's a higher threshold of $32,000.
32, okay.
However, and this is a really big however, there's a very important exception for those married filing separately. If you lived with your spouse at any time in 2024, your base amount is $0. Zero.
Zero. Wow, so that means...
It effectively means virtually all your benefits will likely be taxable if you fall into that category. It's a significant point for tax planning for married couples who might consider filing separately, a very different outcome.
Yeah, that distinction for married filing separately is huge, something people really need to be aware of. Okay, so let's walk through the concept of Worksheet A, understanding how this provisional income is calculated and why each part matters, rather than getting bogged down in, like, line numbers.
Let's do it. Worksheet A conceptually combines a few key income figures. First, you take the total net benefits from Box 5 of all your SSA 1099 and RRB 1099 forms, your total net benefits for the year.
Okay, the total from Box 5.
Then you use half of that total, just
Right.
50%. To this 50%, you add all your other taxable income. Think pensions, wages, interest income, ordinary dividends, capital gain distributions, IRA distributions, basically everything else that's normally taxed.
Right.
And it's crucial to understand that at this stage, for Worksheet A, this amount should not be reduced by any deductions or exclusions. We're looking at gross income here for this specific comparison.
Okay, no deductions yet, just the income.
Exactly. And here's a surprising twist, something many listeners might not realize. You also add in any tax-exempt interest income.
Wait, tax-exempt interest, like from municipal bonds?
That's the one. Even though this interest itself is not taxable on your return,
Right.
it does factor into determining the taxability of your Social Security or railroad retirement benefits.
Huh. That's counterintuitive.
It is, but it's a crucial insight. Income that isn't directly taxed can still influence the taxability of other income sources. It really underscores the interconnectedness of tax rules. You can't look at things in isolation.
Good to know. So you add half your benefits all your other taxable income, no deductions, and your tax-exempt interest. That sum is the provisional income.
That's it. That's your provisional income for the purpose of this initial check on Worksheet A. Once you have your provisional income number, you simply compare it to your specific base amount, the $25,000 or $32,000, or $0 if applicable based on your filing status. If your provisional income is less than or equal to your base amount, then none of your Social Security or Railroad retirement benefits are taxable.
Bill.
Done. Pretty much. It's a very straightforward check designed to save you from more complex calculations if your income falls below these specific thresholds. It's a quick way to achieve peace of mind.
Let's use an example to make this super clear. Let's take the one directly from the publication. Imagine a single filer, over 65.
Okay.
They receive $1,500 in net Social Security benefits in Box 5. Just $1,500. They also have a $16,000 taxable pension and $700 in interest income. And importantly, they had no tax-exempt interest. How does this play out for them, conceptually?
Okay, good example. For this single filer, we first take half of their $1,500 in Social Security benefits. Half of $1,500 is $750.
$750.
Right. Then we add in their other taxable income, the $16,000 pension and $700 in interest, which totals $16,700.
Okay, $16,700.
And since they have no tax-exempt interest, that part is zero. So adding these together, their provisional income comes out to $750 plus $16,700, which is $17,450.
$17,450. So what does this all mean for this single filer? This is where the aha moment really hits.
Exactly. Since their provisional income of $17,450 is significantly less than the $25,000 base amount for a single filer.
Right, $25K was the threshold.
None of their Social Security benefits are taxable for 2024.
Fantastic.
This is a great aha moment for many people. It clearly shows that you might not owe tax on your benefits even if you have other sources of income, especially if the benefit amount itself is relatively low. This scenario perfectly illustrates how meeting that specific income threshold can lead to a clear tax reduction or elimination, in this case for these benefits.
That's incredibly helpful. It simplifies things significantly if you pass this initial test. But quick question. Even if your benefits aren't taxable, like in this example, do you still need to file a return?
That's a really important reminder. Yes, absolutely. Even if none of your Social Security or Railroad retirement benefits are taxable, you might still be required to file a tax return if your total gross income exceeds the minimum filing requirement for your filing status and age.
Ah, okay.
The non-taxability of these specific benefits doesn't automatically mean you're exempt from filing overall.
So for our example filer.
Right. For our example filer, their total gross income was the $1,500 in Social Security plus the $16,700 in other income, totaling $18,200. This amount would likely still require them to file a federal tax return, even though the $1,500 wasn't taxable. You still have to consider all income sources for the filing requirement.
Okay, so what happens if Worksheet A told you that some of your benefits might be taxable? Maybe your provisional income was higher than that base amount.
Yeah.
Then it's time for the main event, I suppose. Worksheet 1. This is where we get specific about how much of your benefits you'll actually report as taxable income, isn't it?
That's right. Worksheet 1 is the more detailed calculation.
And this is where the item-by-item detail of tax reporting for these benefits truly comes into play. Understanding the logic behind each component here can directly impact your final tax bill and, your overall tax optimization strategy.
Indeed. Worksheet 1 is more comprehensive, definitely. It's designed to calculate the precise amount of your Social Security or Railroad retirement benefits that are subject to tax. Instead of just going line by line numerically, maybe let's explain the purpose of each step and its significance, focusing on the concepts and highlighting where potential tax-saving opportunities might exist through careful reporting.
Yeah, that sounds much better. Concepts over line numbers.
Okay. First, a quick but critical note we mentioned earlier. If you're married filing separately and you lived with your spouse at any time in 2024, you'll have special instructions. It generally means a much higher portion of your benefits will be taxable. Often 85% is calculated much more directly. So be aware of that.
Right. That $0 base amount effect carries through.
It does. Also, just to reiterate, if your repayments from Box 4 were more than your gross benefits from Box 3, meaning Box 5 is negative, you don't use this worksheet at all. None of your benefits are taxable. That's an immediate win. Stop right there.
Okay. Assuming Box 5 is positive and Worksheet A indicated potential taxability, let's break down the logic of Worksheet 1.
Okay. You start with your total net benefits from Box 5, the same figure we used on Worksheet A. This full amount is what you'll initially report on your main tax form, usually line 6A on the form 1040 or 1040 SR. That's your starting point.
We're on 6A. Okay, that's the total benefit received.
Correct. The next step, conceptually, is again to take half of that total net benefit amount. Just like in Worksheet A, that 50% figure is a crucial component.
Okay, half the benefits again.
Yes. Then you gather up nearly all your other taxable income again. Think wages, pensions, regular interest, ordinary dividends, capital gains, IRA distributions, and so on. This is about building a complete picture of your total financial situation for this calculation. And here's a subtle but important point, a real item-by-item detail. If you have excluded interest from Series EE and I U.S. savings bonds used for education expenses filed on Form 8815, the IRS has specific instructions. You typically don't include the full taxable interest line from your 1040 here. You use the amount from Schedule B instead. It's a small detail, but it can matter for accuracy if that applies to you.
Good flag for those specific bondholders.
Definitely. Next, you factor in any specific exclusions or adjustments that can reduce the overall income base the IRS uses for this calculation. This is where some tax optimization can come in. These can include things like adoption benefits excluded on Form 8839, foreign earned income or housing exclusions from Form 2055, or income from bona fide residents of American Samoa or Puerto Rico.
So these reduce the income used in this calculation.
Exactly. These exclusions effectively lower your adjusted income for the purpose of this calculation, potentially pushing you below a taxability threshold or reducing the taxable portion of your benefits. It's crucial to claim any exclusion you're entitled to here. And don't forget, you also add back in that tax-exempt interest here, just like in Worksheet A.
Ah, the tax-exempt interest still counts. Okay.
It does. After these adjustments, you arrive at an adjusted total income figure. Let's call it your comparison income for Worksheet 1. This figure is then compared against two critical thresholds, which determine whether 50% or up to 85% of your benefits become taxable.
Two thresholds now, okay.
Yes, Worksheet 1 has two tiers. The first threshold is the same as the base amount from Worksheet A. $25,000 for single filers, head of household, qualifying surviving spouse, or married filing separately if you lived apart from your spouse all year.
And $32,000 for married filing jointly.
Right. If your comparison income figure is at or below this first threshold, good news. Your Social Security benefits are still not taxable, even if you failed the quick check on Worksheet A. This is sort of your second chance to have zero taxable benefits.
Okay, another potential off-ramp.
Exactly. However, if your comparison income is above that first threshold, $25K, $32K, then a portion of your benefits will become taxable, up to 50%. The worksheet then involves a series of steps to calculate that 50% portion based on how much your income exceeds that first threshold. It's basically the smaller of half your benefits, or half the amount your income is over the threshold.
Okay, so crossing threshold 1 means some tax, up to 50%.
Correct. But wait, there's that second threshold. If your income goes even higher, specifically above $34,000 for single filers and similar statuses, or above $44,000 for married filing jointly.
34 and 44,000, higher numbers.
Right. If your comparison income exceeds the second threshold, then an even larger portion of your benefits can become taxable, potentially up to 85%.
85%, that's a big jump.
It is. This distinction is vital for understanding the maximum taxable portion. The calculation gets a bit more complex here, basically figuring out how much of your income falls between the first and second thresholds, taxed at 50%, and how much falls above the second threshold, potentially bringing in the 85% rule. Finally, the worksheet compares the result of these combined 50% and 85% calculations with the simple calculation, 85% of your total net benefits from box 5. You report the smaller of those two figures as your final amount of taxable Social Security or railroad retirement benefits.
Okay, so it's capped at 85% of your total benefits, even if the formula technically goes higher.
Exactly. The taxable amount can never exceed 85% of your net benefits. That final smaller number is the crucial one you've been working towards, and it's what you'll enter on your tax form, usually line 6B of the 1040 or 1040 SR.
Line 6B, got it. That's a much clearer way to explain the flow, focusing on the thresholds and the logic. Let's look at the sources example 1 and example 3 again to really solidify this. We don't need to narrate every single line number, but let's talk about the outcome and why it happened based on these thresholds. First, example 1, the single filer.
Okay, example 1 revisited with worksheet 1 logic situation. Our single filer received $5,980 in net Social Security benefits, box 5. They also had $28,990 in other taxable income. Pension, wages, interest, no tax-exempt interest.
Okay.
Calculation. We take half the benefits, $2,990, and add it to the other income, $28,990. That gives a comparison income of $31,980.
$31,980. How does that compare to the thresholds for single?
Well, it's above the first threshold of $25,000.
Right, so some is taxable.
But it's below the second threshold of $34,000.
Okay, so it doesn't hit that 85% trigger zone.
Exactly, because it's between the two thresholds. The calculation focuses on that 50% rule. It essentially compares half the benefits, $2,990, with half the amount the income is over the $25,000 threshold. $31,980, $25,000, half of that is $3,490. The taxable amount is the smaller of those two. So the smaller of $2,990 and $3,490 is $2,990.
So $2,990 of their benefits are taxable. What does this all mean for our single filer?
In this case, exactly half, $2,990 out of $5,980 of their total Social Security benefits became taxable. This scenario perfectly illustrates how the thresholds work in practice. Crossing the initial threshold means some benefits are taxed, but because they stayed below the second threshold, it was capped within that 50% calculation range. It's targeted taxation, directly linked to your income level relative to those two key thresholds.
That makes perfect sense. Okay, let's look at example 3, the married couple filing jointly. This one had higher income and that U.S. savings bond interest nuance.
Right. Example 3. Jamie and Jesse Johnson situation. Filed jointly. Jamie received $10,000 in railroad retirement benefits, box 5. Jesse had a $38,000 pension. They had $2,300 in regular taxable interest plus $200 in interest from a qualified U.S. savings bond that was eligible for exclusion, meaning it wasn't taxed directly but still factored in potentially. Let's assume, for simplicity here, that the $200 savings bond interest is included in their adjusted gross income calculation for this purpose. As Publication 915's example suggests complexity we won't fully detail line by line. So total other income components are roughly $38,000 plus $200,300 plus $200, $40,500.
Okay, $10K benefits, roughly $40, $5K other income stuff.
Calculation, we take half the benefits, $5,000, and add it to the other income, $4,500. That gives a comparison income of $45,500.
$45,500. Now, how does that compare to the thresholds for married filing jointly?
Now we see a difference. The first threshold for MFJ is $32,000. Their $45,500 is way above that.
Definitely.
The second threshold for MFJ is $44,000. Their $45,500 is also above that second threshold.
Oh, so they crossed both lines.
They did. This means they're potentially in the 85% taxability zone. The calculation gets more involved considering income over both thresholds. Skipping the detailed math from the worksheet, the final result for them was that $6,275 of Jamie's $10,000 in benefits became taxable.
Wow, $6,275 out of $10,000. That's 62.75%, significantly higher than 50%, heading towards that 85% maximum.
Exactly. Because their income crossed that higher $44,000 threshold, a larger portion of the benefits got pulled into the taxable calculation according to the 85% rule component.
This raises an important question. For those nearing, or maybe just over, these higher income thresholds, understanding this calculation is absolutely key. It shows how rapidly the taxable percentage of your benefits can increase once your provisional income crosses those specific lines, 34K or 44K.
It's absolutely vital. For Jamie and Jesse, crossing that second threshold made a big difference in the taxable amount. Understanding these thresholds and the mechanics of Worksheet 1 is crucial for accurate tax reporting and, maybe more importantly, for identifying potential areas where strategic financial planning, like managing withdrawals from other accounts, timing income, etc., could help manage your overall comparison income and potentially reduce the amount of your benefits subject to tax. It highlights the power of planning.
Okay, this next one sounds really interesting, especially for people who might get a surprise large payment. For those who received a big payment for previous year's benefits all at once, maybe due to a disability approval or some correction.
Right, a retroactive payment.
There's a special provision that could potentially reduce your tax bill quite a bit. It's a brilliant example of how knowing the rules can lead to significant tax optimization. It's called the lump sum election. Tell us about this.
This is indeed a fantastic tax-saving strategy, and honestly one that often gets overlooked because it's not immediately obvious. It requires a bit of extra work, but the payoff can be substantial. Here's the core concept. If you received a large one-time payment in 2024 that includes Social Security or railroad retirement benefits that actually belong to one or more earlier years, specifically for years after 1983, you have a special option.
An option? What is it?
Instead of simply including the entire lump sum in your 2024 income for tax calculation purposes, using Worksheet 1 like we just discussed, you can choose to refigure your taxable benefits as if you had received that lump sum amount in those earlier years it actually applied to.
You pretend you got the money back then.
Essentially, yes, for calculation purposes only.
What is-
Why is this such a powerful tax-saving method? Think about it. A large lump sum received in a single year could push your overall income way up for 2024.
Right, could bump you into a higher bracket.
Exactly. It might not only bump you into a higher federal income tax bracket overall, but critically for this discussion, it could easily push a larger percentage of your total Social Security or railroad retirement benefits, including the lump sum portion, from the 50% taxable tier straight into the 85% taxable tier within that current year, 2024.
Because it inflates your provisional income for that 1 year.
Precisely. By electing to spread that income back to the earlier years it pertained to, you're essentially applying the tax rules, the income thresholds, and your own income situation that were in place for those specific earlier years. This often means the benefit portion attributable to those prior years might fall into lower tax brackets or lower benefit taxability thresholds, maybe only 0% or 50% taxable back then instead of 85% now. This results in a lower overall tax liability for the current year, 2024. It's about leveling out an income spike that could otherwise cost you a lot more in taxes.
So it's about avoiding that income spike effect that a large one-time payment can create and strategically applying the rules from prior years to your current tax obligation. That sounds smart. What's the process for doing this? It sounds a bit intricate, maybe involving more worksheets?
It does involve a set of additional worksheets provided by the IRS within Publication 915, specifically Worksheet 2, which covers years after 1993, or Worksheet 3 for the older years 1984 through 1993. You'd need to complete a separate Worksheet 2 or 3 for each earlier year for which you received a portion of that lump sum payment in 2024. So if the payment covered, say, 2022 and 2023, you'd do 2 worksheets.
Okay, one for each prior year. Then what?
Then you combine the results from those calculations, basically, the taxable benefit amounts you figured for each prior year on Worksheet 4. Now, the crucial reminder here, straight from the IRS, a very important caution. Do not file an amended return, like a 1040X, for those earlier years.
Oh, okay. Don't refile old returns.
Correct. This election is purely for calculating your current year's tax liability, for 2024 in this case. You're not changing your old tax returns. You're simply using the prior year's tax rules and income situations to determine the taxable portion of your 2024 lump sum payment. Worksheet 4 is the final step. It compares the total taxable benefits calculated using this prior year method with the taxable benefits you would have figured using the standard Worksheet 1, including the whole lump sum in 2024. If Worksheet 4 shows that the prior year method results in a lower total taxable benefit amount,
Which is the goal.
then you use that lower amount as your taxable benefit on line 6B of your 104010140SR. And importantly, you check the box on Form 1040 or 1040SR line 6C.
Line 6, what does that box signify?
That checkbox signals to the IRS that you've elected to use this special lump sum method for calculating your taxable benefits. It tells them why your Line 6B amount might look different than expected based on just your 2024 income and Box 5 total. It's a strategic move that acknowledges your income spike and applies the appropriate relief calculation.
This is a perfect example of how truly understanding the tax rules can save you real money. It's not about hiding income, not at all. It's about intelligently applying the tax code to your specific situation to achieve the most favorable and correct outcome.
Exactly.
It really emphasizes the importance of looking closely at that form SSA 1099 or RRB 10099, especially if you see details about prior year benefits included in Box 3. Don't just plug Box 5 into Worksheet 1 without thinking if the selection applies. It's a key opportunity for financial optimization.
Absolutely. It requires more work, gathering info from prior years, but the savings can be well worth the effort. #TAG-V. Important deductions and special scenarios.
Okay, beyond the main calculations for figuring taxable benefits and that really helpful lump sum election, are there any other unique situations or deductions related to these benefits that our listeners should know about? Because, those are often where additional tax-saving opportunities can hide, sometimes in plain sight.
Absolutely. Publication 915 covers a few other specific scenarios that are really important to be aware of, as they can directly impact your tax liability, sometimes even leading to a significant deduction or credit. Understanding these nuanced rules is essential for comprehensive tax planning and making sure you're not paying more than you owe. First, let's quickly revisit the repayments more than gross benefits scenario, just because it's such a clear win. We touched on this when discussing box 5 being negative.
Right, where box 4 is bigger than box 3.
Exactly. To reiterate this key tax saving point, if your total benefits repaid, box 4, were more than your gross benefits received, box 3 in 2024, your net benefits in box 5 will be a negative figure. In this situation, as we said, none of your Social Security or railroad retirement benefits are taxable for the year. It's a straightforward calculation with a direct financial benefit. And if you happen to have multiple forms, say one SSA 199 and one RRB 1099, a negative figure on one form in box 5 is used to offset a positive figure on another form for that same year before you determine if your overall total net benefits are negative. You combine them first.
Okay, good clarification on multiple forms. Now, what about repaying benefits from a previous year? You mentioned box 4 is for repayments made in 2024. What if that repayment was for benefits you actually received and paid tax on in an earlier year?
Ah, yes, that's the repayment of benefits received in an earlier year scenario. This is a truly critical deduction or credit opportunity and another potentially powerful tax-saving move, especially if the amount you repaid is significant. Here's the rule. If you repaid benefits in 2024 that you had previously included in your gross income in an earlier year, and that repayment is more than $3,000,
Over $3,000. Okay.
you get to choose the more beneficial tax treatment for that repayment in 2024. This choice can lead to substantial savings, so it's worth understanding both options.
Okay, what are the two options if the repayment is over $3,000?
Option 1 is straightforward, but maybe less beneficial for many now. You can simply deduct the amount of the repayment as an itemized deduction on Schedule A, Form 1040, likely as a claim of right repayment.
But with the higher standard deductions these days.
Exactly. Most taxpayers now take the standard deduction. So unless you have a lot of other itemized deductions, this option might not actually reduce your tax bill at all.
Right. So what's option 2?
Option 2 is often the more powerful and strategic choice, though it requires more calculation. You calculate your tax for 2024 two distinct ways. First, you figure your tax for 2024 without taking any deduction for the repayment. This is your baseline tax. Second, you figure your tax for 2024 again, but this time you take a credit for the amount of tax you originally paid in the earlier year, specifically because of those benefits that you now repaid.
How do you figure out that credit amount?
You essentially have to refigure your tax for the earlier year, the year you originally received and were taxed on the benefits, without including those specific benefits in your income for that year. The difference between the tax you actually paid back then and the tax you would have paid without those benefits, that difference is the credit you can take on your 2024 return.
I see. So you calculate the tax reduction you would have gotten in the past year if you hadn't received the overpayment.
Precisely. Then you compare the outcome of option 1, the itemized deduction if it helps, with the outcome of option 2, taking the credit figured from the prior year. You use the method that results in the lower total tax for 2024.
This raises an important point. If you find yourself in this situation with a repayment over $3,000, calculating it both ways is absolutely essential to optimize your tax outcome. You can't just assume one method is better. That second option, the credit, could often lead to a much larger financial benefit, especially if your tax rate was higher in the earlier year.
Exactly. It requires a bit more effort, maybe digging out old tax returns, but the potential tax savings make it absolutely worthwhile. You're effectively getting tax relief for income you thought you had but ultimately had to give back, and the IRS provides this mechanism to ensure you get the most beneficial treatment allowed under the law. It's fair.
What if the repayment is $3,000 or less, though? Does it still work?
Unfortunately, no. If the repayment of benefits received in an earlier year is $3,000 or less, it falls under the category of miscellaneous itemized deductions subject to the 2% floor, which were suspended under current tax law.
So no deduction or credit if it's $3,000 or less.
Correct. That $3,000 threshold is key for getting a tangible tax benefit from the repayment on your current return. Below that, there's currently no federal tax relief for it.
Okay, that's a critical distinction.
Yeah.
Now, are there other things, maybe not direct taxes, that are affected by how Social Security is taxed?
Yes, definitely. Beyond income tax itself, there's another critical consideration often tied closely to that provisional income calculation we discussed, IRMA.
IRMA, Income-Related Monthly Adjustment Amount for Medicare.
That's the one. It's not technically a tax, but it functions like one. It's a surcharge added to your Medicare Part B and Part D premiums if your modified adjusted gross income, MAGI, from 2 years prior exceeds certain thresholds.
2 years prior.
Yes, there's a 2-year look back for the standard calculation, though you can appeal based on life-changing events. But here's the fascinating connection. The MGI calculation used for IRA-MAA is very similar to the provisional income calculation used for taxing Social Security benefits. It includes things like tax-exempt interest.
So higher provisional income for Social Security taxability could mean higher Medicare premiums via IRA-MAA.
It absolutely can. If your provisional income calculation for Social Security taxability shows you are just over a threshold, either the 25K 32K or the 34K 44K one, that same higher income could very well push you into a higher IRA-MAA tier, meaning you pay significantly more for your Medicare coverage.
Wow, a double whammy potentially.
It can be. So, strategically managing other income sources, maybe delaying large IRA withdrawals, timing Roth conversions carefully, considering where you hold investments, taxable versus tax-advantaged accounts, can potentially help keep your income below these thresholds for both Social Security taxability and IRA. This offers multifaceted savings and financial optimization. It requires looking at your whole financial picture, not just Social Security in isolation.
That's a fantastic point about the interconnectedness of these calculations and the potential impact on Medicare costs. What about international aspects again, quickly? Any other key treaty points?
Just briefly on the non-resident aliens and tax treaties again. We mentioned benefits might be exempt for residents of certain treaty countries, Canada, Germany, Ireland, Japan, UK, etc. If you are a resident of one of these countries and your benefits are exempt, the SSA or RRB typically won't withhold U.S. tax. If the RRB does withhold tax and you believe you're exempt under a treaty, you can claim an exemption from withholding by filing Form RRB 1001 with the Railroad Retirement Board. That stops unnecessary withholding. And conversely, just something to note, if you're a U.S. resident receiving Social Security type benefits from, say, Canada or Germany, tax treaties often state these should be treated as if they were U.S. Social Security benefits for tax purposes. So you'd include them in your provisional income calculation here in the U.S.
Got it. These special scenarios, the repayment rules, the IRMAA connection, the treaty nuances, these are exactly the kind of detailed strategic insights that can make a monumental difference for people's tax returns and their overall financial well-being. It's clearly not just about filling in the boxes on the form. It's about understanding all the options available to you and how different financial decisions interact. It's truly empowering information.
It really is. Knowledge is power when it comes to taxes.
Okay, this has been a lot of really detailed information, and I can see how it might feel overwhelming for some listeners trying to absorb it all. But the good news is the IRS actually provides a ton of resources to help people out, right?
Oh, absolutely. They do.
Our listener wants to gain knowledge quickly but thoroughly, and these resources seem invaluable for navigating something as complex as tax forms, worksheets, and the implications of these benefit payments. You are definitely not alone in trying to figure this out.
They truly are invaluable. The IRS understands that tax matters can be complex, and they offer a really robust suite of resources, many of which are completely free, to help taxpayers confidently manage their obligations. Your primary hub for practically everything tax-related is, of course, irs.gov.
The website.
Yep, that's your go-to for all the forms, publications like Pub 915 that we've been discussing, and all the instructions. It's incredibly comprehensive, and it's often available in multiple languages: English, Spanish, Chinese, Korean, Russian, Vietnamese, which is great. Their search feature is quite powerful, and they have interactive tools too.
Like what?
Well, there's the Interactive Tax Assistant, or you can find it at irs.govita. It can guide you through specific tax questions based on your input, almost like having a personal tax assistant walking you through a decision tree. It's pretty neat for specific issues.
That sounds useful. What about actual help preparing the return, especially if maybe you qualify based on income or age?
Yeah. Beyond self-help tools, the IRS also sponsors several excellent free tax preparation services. These are fantastic resources for hands-on help getting your return done correctly. First, there's Direct File, which you can find at irs.gov Direct File. This is relatively new but now permanent. It allows eligible taxpayers to file simple federal returns online, for free, directly and securely with the IRS itself, assuming you're in a participating state.
Directly with the IRS. No third-party software.
For the federal part, yes. It doesn't prepare state returns, but it guides you to state-supported tools if you need them. It's an exciting development for simpler returns. Then there's the long-standing Free File program at irs.gov Free File. This lets you prepare and file your federal individual income tax return for free using commercial tax software partners or online fillable forms, typically if your income is below a certain level. It's a great way to use professional-grade software without the cost.
Okay, so Direct File and Free File are good online options. What about in-person help?
Two main programs there. The Volunteer Income Tax Assistance, VIT program, IRS.gov offers free tax help typically to people with low to moderate incomes, persons with disabilities, and limited English-speaking taxpayers. These volunteers are IRS certified and trained. And the Tax Counseling for the Elderly TCE program, IRS.gov TCE, offers free tax help for all taxpayers, but they particularly specialize in helping those 60 years of age and older.
TCE sounds perfect for this topic.
It really is. TCE volunteers are often retired individuals themselves and specialize in answering questions about pensions and retirement-related issues, which is spot on for our deep dive topic today covering Social Security and railroad retirement.
That's fantastic. Any specific help from military?
Yes, for military families, MilTax is a free tax service available for U.S. Armed Forces members and qualified veterans. It's offered through the Department of Defense and provides online software and personalized support. The availability of all these services means you don't have to navigate complex forms like Worksheet 1 completely on your own if you need assistance. They can help ensure you accurately report your benefits, claim all eligible deductions and credits, and really optimize your financial outcome.
Those free services are truly fantastic resources and probably underutilized by many who qualify. What about online tools for proactive planning throughout the year, not just at tax filing time?
Yeah, the IRS provides several useful tools for that too. The tax withholding estimator at irs.gov W4 app is incredibly useful. It helps you estimate the federal income tax you want withheld from your paychecks, pensions, or other income.
To avoid surprises at tax time.
Exactly. It helps prevent a large tax bill or maybe a surprisingly large refund, which means you could have had more money throughout the year. It helps you get your withholding rate. Also, the IRS online account at irs.gov account is a secure portal. You can log in to view your personal tax history, see payments you've made, access transcripts, all vital information for accurate tax planning and knowing your current standing with the IRS. You can even view digital copies of select IRS notices sent to you.
That sounds really convenient.
It is. Finally, a quick word on tax preparers. While a paid preparer can be a great resource, especially for complex situations, it's essential to remember that even though they sign the return, you are ultimately responsible for its accuracy.
Right, the buck stops with you.
It does. So choose wisely, look for credentials like CPAs, enrolled agents, or attorneys, check their history, and ensure they are reputable. The IRS has tips on choosing a preparer on their website, too. And if you ever run into problems with the IRS that you just can't seem to resolve through normal channels, don't forget the Taxpayer Advocate Service, TAS. Yes, TAS is an independent organization within the IRS. Their job is specifically to help taxpayers resolve problems and protect taxpayer rights. You can reach them toll-free at 877-777-4778 or visit taxpayeradvocate.irs.gov. They are your voice at the IRS and can help with issues causing financial difficulty or when you're not getting timely responses. They even publish the Taxpayer Bill of Rights, which details 10 basic rights every taxpayer has, ensuring fair treatment.
Knowing TS exists is great backup. The takeaway here seems clear. You're truly not alone in navigating this. The IRS provides incredible support, much of it free, to help you understand and correctly report your benefits. It's all about empowering yourself with knowledge and knowing precisely where to turn for help, ensuring you can confidently prepare your tax returns and identify those precious financial optimization and tax-saving opportunities we've discussed.
Absolutely. The resources are there. You just need to know where to look and take advantage of them. #TAC@TAC_outro.
Wow, what a journey we've taken today. We started with simply receiving your Social Security or Railroad Retirement Benefit Statements, those SSA 1099s or RRB 1099s.
Right?
We identified the truly critical Box 5 net benefit amount, then performed that quick but powerful check with Worksheet A to see if any benefits were taxable at all, based on those $25,000 or $32,000 base amounts.
That first filter.
Yeah.
Exactly.
From there, we dove deep into the logic of Worksheet 1 for the precise calculations, understanding those two tiers of taxability, the 50% and the potential 85% based on the $34,000 and $44,000 thresholds.
Getting into the real detail.
We did. And we uncovered powerful optimization tools like the lump sum election for prior year benefits, which sounds like a huge potential saver. We also discussed crucial repayment deductions and credits, especially that over $3,000 rule.
And the surprising connection to IRMAA and Medicare premiums, which adds another layer to planning.
Absolutely. Knowledge is most valuable when understood and applied, isn't it? This deep dive really shows that even seemingly complex tax topics like the taxation of Social Security benefits can be broken down into manageable, understandable steps if you know where to look, like Publication 915.
That's right. And critical thinking is so essential in today's world of information overload. Truly understanding these specific rules, how they interact, and how to apply them, especially the various tax saving strategies we highlighted, can genuinely impact your financial planning and your bottom line tax outcome. It's about being informed, not overwhelmed, and using the rules to your advantage where possible.
So as you, our listener, consider your own benefit statements for the upcoming tax season, think about this. Now that you understand the thresholds, the two tiers of taxability, 50% and 85%, the impact of other income sources like tax-exempt interest, and the various strategic options available like the lump sum election or careful timing of repayments, what changes could you potentially make in your overall financial picture? Maybe related to timing other income, exploring Roth conversions, managing IRA withdrawals, or even just being aware of how future lump sum payments could be handled to potentially optimize your tax situation regarding your Social Security or Railroad retirement benefits, and maybe even minimize those IRMA surcharges on your Medicare premiums. What stands out to you from this deep dive that you'll apply to your own tax planning to potentially save money or simply gain that invaluable peace of mind? Keep digging, keep learning, and stay informed.